Hey everyone, and welcome back. Imagine you own a business, Mario's Game Shop. You buy the same game from a supplier 3 times during the year, but because of inflation, the price goes up each time. You start the year with 100 units that cost you $7 each. In April, you buy 300 more at $9 each, and in October, another 600 at $11 each. In total, you have 1,000 units available to sell, and you spent a total of $10,000 on them. During the year, you sell 800 units, which means you have 200 left. This leads to a surprisingly tricky puzzle. What was the cost of the 800 games you sold, and what is the cost of the 200 you have left? To answer this, companies use what are called inventory cost flow assumptions. And here's the crucial point. Companies are allowed to assume which units were sold, even if that assumption doesn't match how the games actually left the shelf. Today, we're going to solve this puzzle by exploring the 4 methods companies use to make this assumption. First is the most logical method, specific identification. This method matches each item sold with its actual cost. It's used for businesses with unique, high-value items like a car dealership or an art gallery. For Mario's, if we knew exactly which games were sold, we could calculate the precise cost of goods sold and ending inventory. However, this is impractical for most companies with large volumes of identical items. This brings us to our first major assumption, FIFO, or first in, first out. With FIFO, we assume the first units we purchased are the first ones we sold. Think of milk in a grocery store. They want to sell the oldest stock first. To calculate the cost of our 800 units, we start from the top of our inventory list. We assume we sold the first 100 units from beginning inventory, all 300 from the April purchase and 400 from the October purchase. This gives us a cost of goods sold of $7,800. The 200 units left are the newest ones, valued at $2,200. A common mistake here is forgetting to include beginning inventory as the very first purchase. Next is LIFO, or last in, first out. Here, we assume the opposite. The last units purchased are the first ones sold. Think of a stack of firewood you take from the top of the pile. To find the cost of our 800 units, we start from the bottom of our inventory list. We assume we sold all 600 units from the October purchase and 200 from the April purchase. This results in a cost of goods sold of $8,400. The ending inventory is now made up of the oldest units, valued at $1,600. Our final method is weighted average cost. We assume all our units are mixed together at a single average cost. First, we calculate the weighted average cost per unit by taking the total $10,000 cost of goods available and dividing it by the total 1,000 available units. This gives us a cost of $10 per unit. Be careful not to use a simple average of the prices. It must be a weighted average. Then, we apply this cost to our units. 800 units sold costs $8,000, and 200 units in ending inventory costs $2,000. Let's step back and look at the results. We started with the same $10,000 of goods available, but each of our 3 methods gave us a different cost of goods sold and a different ending inventory. This diagram is the perfect summary. On the left, we have our total pool of inventory available. Under FIFO, we get a cost of goods sold of $7,800 and ending inventory of $2,200. Under LIFO, we get a cost of goods sold of $8,400 and ending inventory of $1,600. And with weighted average, we get a cost of goods sold of $8,000 and ending inventory of $2,000. Notice that for every method, the cost of goods sold plus the ending inventory always equals our $10,000 cost of goods available for sale. So, what's the big takeaway? The inventory cost flow assumption a company chooses is a major decision. It directly impacts the company's reported profit on the income statement and the value of its inventory on the balance sheet. Remember the key point. This is an assumed flow, not necessarily the actual one.